Scott, talk a little bit here about the fine line that the Federal Reserve is walking here, in that it has to acknowledge the risks out there, whether it's trade, whether it's emerging markets, whether it's fiscal policy, at the same time that the economy is doing well, very well, in fact, very strong were the exact words, and the rate hike path should remain consistent with what they've laid out already.
Well, I think, Mike did a pretty good job, and I think the outlook is pretty sunny. And, just as far as today's data, I mean, that ISM services number was a great number. So I think things are moving ahead here. But certainly the Fed wants to point out the trade issues. In our opinion, there's a relatively low probability that we're going to have really an all-out trade war. But certainly the recent rhetoric over the last couple of weeks, it increases the probability. And obviously the market is nervous about that from time to time. So, from our perspective, what we're trying to do, we're trying to focus on what's the economy likely to do, what's the Fed likely to do. I don't think, our official call is we're looking for a total of 3 hikes this year, so just one more. And we in the equity group have held really since the fall of 2016 that if the Federal Reserve hiked interest rates more than 3 times this year, that'd probably be a headwind for the equity market. And I think that's still likely the case, but it's probably not as serious of a headwind as maybe it would have been 6 months ago.
Scott, give me your take on another headline that we're getting from the FOMC saying some firms cope with labor shortage by salary increases. We've talked a lot about salary increases and wage growth, or really up until this point, sort of a lack of wage growth. What effect, if any, does this have on the equity markets, especially as we start to go into earnings season and look at corporate profits?
Well, Taylor, I tell you, tomorrow's number, and, I've argued this for the last 6 months, if not more. The biggest part of tomorrow's number, the most important piece of data, at least in my mind, is what's the year-over-year change in average hourly earnings. And, clearly on February 2nd, when that January report came out and the number was higher than expected, I mean, that's what sent the market on a pretty quick 10% pullback. So I think the market is very sensitive to wages. Tomorrow, it's expected to be about a 2.8%. I still say that really the red line for these wages is 3% or above. If we got a reading there tomorrow, or maybe in the next couple of unemployment reports, the stock market probably wouldn't like that. But certainly wages are a huge issue, not just for the overall inflation feeling, so to speak, but also for corporate margins. So the Fed's watching it closely, the market's watching it closely, and anything that has any implications to do with is the Fed going to quicken its pace or anything like that is going to be important economic data. Absolutely.
And you're referring, of course, to average hourly earnings year over year, scheduled, or I should say forecast increase 2.8%. On a month over month basis, forecast increase 0.3%. I want to go to the yield curve here because Mike McKee pointed out something that was in the discussions, which is that some policymakers saw the yield curve, the flattening yield curve, as a less reliable indicator of future economic activity. As an equities guy, what's your take on this? Do you agree that that's the case?
Well, the market's been able to largely shrug it off. And, just here in the last, really this week, we've seen that spread squeeze a little tighter. I do think the market is going to be thinking about that. I would say, it's certainly not 100% reliable, but it's typically an indicator that means sometime, and let's say this is, it's not a fine line, sometime in the next, year to 2 years or something like that, you're likely to slip into a recession. So I think that it is an indicator we want to pay attention to. We're not calling for an inversion of the curve, but certainly, anything at 30 basis points or anywhere close to that is pretty tight. So I think it's reliable in a sense that it tells you that you're in the later stages of an economic cycle, and maybe a recession's not on the very near-term horizon, but it's likely out there at least within the next couple of years.
So you mentioned that we're getting into being in the late stage of a business cycle. I've talked to a lot of analysts, and at this point they're getting a little bit more defensive, getting into a little bit more of those liquid names ahead of jobs day tomorrow. As you approach a late stage business cycle, how defensive are you getting?
We don't want our clients to get too defensive here. I mean, I think this market still has some legs. I think this cycle still has some time to play out. And while we've seen this increased volatility over the last couple of weeks, and things like staples and utilities and that have done better, that's not what we want our clients focusing on. We want them leaning toward the consumer discretionary sector, industrials, which are obviously very sensitive to this trade situation, financials, which are obviously sensitive to the 10-year yield being down here at 283 or 4. But when we look ahead, I think that what you're going to find is the cycle is going to play out for a bit longer. Let's say the tax code change extended it for a year or two. So we want to be leaning towards those sectors that are going to be sensitive to that, and we don't want our clients getting defensive. We're underweight utilities, we're underweight staples. Sometime out there on the horizon, you'll want to get more defensive. I think right now is the wrong time. So
you don't want to get too defensive, but do you want to be adding to positions in sectors that have gotten hit of late? And I'm referring to, say, consumer discretionary or semiconductors and technology, which have really seen some more pain because they are more dependent on Chinese imports. If the case is that the trade war and the trade rhetoric is not going to play out in the worst case scenario, is this a good time to be adding exposure to some of those sectors that have gotten beaten down?
In particular, industrials, financials, consumer discretionary. We definitely want to make sure that our clients are leaning toward those sectors. If they're not overweight those sectors relative to their weightings in the S&P, then we want them to get there. So yes, we want to take advantage of these underperformance periods.
Scott, just quickly, I want to talk a little bit about small caps and mid caps. I spoke with Gina Martin-Adams, our equity strategist here at Bloomberg, and she was saying that small caps is a great way to protect yourself from trade, but those have had such a big run up that actually mid caps now actually look relatively attractive. Aside from the large caps, when you just look at small versus mid, does mid caps look relatively attractive at this point?
I always throw a mid cap almost really in the large cap barrel, and so I would prefer to look at it as large and mid versus small, and certainly small's had a great year. I think they've run up quite a bit. I think market expectations in terms of earnings is way too high. They underperformed last year. We're moving to the later stages. They would be great protection, obviously, if we have an all-out trade war, which once again, I think that's a relatively low probability. So small caps may have done well here lately, but I think over the course of the next year, let's say, I think there's a good chance that they're underperformers.
Scott, very quickly, we've had some wobbliness over the last 2 weeks, some shift to the defensive posturing here. Now that the tariffs will likely be imposed tomorrow at 12:01 a.m. midnight time, do you suspect that we've seen the weakness already and now you sell on rumor, buy on news kind of situation?
Well, Scarlett, I think we are going to have a little bit of a tit for tat thing here, at least in the very near term. But I think the stock market is playing it right to me, the action tells me we're holding at all these technical levels, which I think are very strong between here and 2650 in the S&P. But I don't think the market believes that we're going to have an all-out trade war. I think that's probably the right way to be. That certainly jives with what we're thinking. And so I think we're still going to see volatility based on that. Yeah. I don't know if tomorrow's the red line, but certainly we're going to see some tit for tat here, almost certainly, at least over the next month or two.